All right, I think this is where we left off yesterday, or not yesterday, would have been Wednesday. Uh, so we had discussed the M&M propositions, and we determined that the in the absence of taxes, the capital structure of the firm changes in the capital structure can't actually change the value of the firm. So the capital structure is essentially irrelevant. So here we move on to discussion of Proposition 2, so M&M Proposition 2, and here we're talking about the components of the return on an investment in the firm. So we're using the capital asset pricing model and its security market line. The security market line is basically the return on any security is equal to the risk-free rate plus the beta of the security times the market risk premium. So we can see that expressed in terms of the asset beta here in the CAPM equation on the slide. So we have the return on the asset is equal to the risk-free rate plus the beta on the asset times the market risk premium. So beta A is the firm's asset beta. So for any financial security or financial instrument or anything that provides a financial return, the capital asset pricing model applies because the return on the market is, by assumption, all potentially valuable financial assets, all financial assets that would potentially provide a return. So it theoretically includes all of the assets in the economy, so it would include real estate and gold and all of the other investments. So we can characterize the firm itself and all of the assets of the firm. If we imagined an all-equity firm, the beta of the assets would be exactly the same as the beta of the equity. But in the case of a leveraged firm, the beta of the assets is proportional to the beta on the equity. We know that the beta is just a linear combination of the betas of the underlying assets. So in the case of the asset beta for the firm itself has a relation to the market value, the market return. So you can characterize that as beta of the asset. Now the return on equity is magnified by the amount of debt in the capital structure. And so we can see by the DuPont equation that the return on assets times the equity multiplier gives you the return on equity. And so if that's the case, then we can see that the beta of the asset is multiplied by the equity multiplier, and that gives you the beta of the equity. It's just a simple linear transformation. So we can go from the capital asset pricing model as it applies to the assets of the firm, and through Proposition 2, we can look at the return on equity and how it's related to the beta of the asset and the amount of debt in the capital structure, so the amount of leverage. So if we replaced RA with the capital asset pricing model, assuming the debt is riskless, so the assumption that debt is riskless really doesn't make any difference because we're looking from the perspective of the shareholders. So we're interested in the financial risk to the shareholders. The default risks to the debtors, to the bondholders, is another issue, and so we'll talk about that a little bit later. But if we just assume that the return on the debt is equal to the risk-free rate, that there's no default risk, even in that case, the financial risk to the shareholders would be higher because the levels of debt would cause greater volatility in the earnings available to shareholders, as we've seen in the early part of the lecture. The fact that we have debt, so if we compare the current situation and the proposed situation in our previous example, we can see that the earnings per share is more volatile and the return on equity is more volatile in the presence of debt. And so as a result, there's greater financial risk for any presence of debt, even if the debt is default free and riskless to the bondholders. So once again, we're focusing on the risk to the shareholders in this discussion. So we have the return on the asset determined by the beta of the asset, and we also have the return on equity here, which is related to the beta of the asset through the equity multiplier, 1 plus the debt equity ratio. So this is equity over equity, which is equal to 1, plus debt over equity, which is the debt equity ratio. So we have the total assets divided by equity, because equity plus debt over equity is equal to assets over equity. This is the standard definition of our equity multiplier. So the beta of the assets are multiplied by the equity multiplier through a linear transformation, and that gives you, as we see in the next slide, that gives you the beta of the equity. So we can see that the beta of the equity is determined by the beta of the asset times the equity multiplier. So therefore, the systematic risk of a stock investment in the firm, or the equity investment in the firm, depends on the systematic risk of the assets, the beta of the assets, or the business risk, and the level of leverage, the amount of debt in the capital structure, which represents the financial risk. So those two components make up the systematic risk of the stock. And of course, all the unsystematic risk associated with the stock should be diversified away in a well-diversified portfolio. So the only relevant risk is the systematic risk. Now, if we add corporate taxes, the idea of case 2 with corporate taxes, we recognize that there's an interest tax shield, which is created by the fact that we get to deduct interest as an expense for tax purposes. And so the implication of that is that when the firm adds debt, it reduces the amount of taxes, and therefore there's a value to the tax shield. The tax shield is that deductibility of debts. And it turns out that the value of the tax shield is just equal to the amount of the debt times the corporate tax rate. And we'll see how that works out in a bit. So, we have the fact that interest is tax deductible, and so adding debt means it reduces taxes, and so an increase in debt implies an increase in interest, and so that increases the cash flow to the firm because the amount of cash flow out to pay for taxes goes down. And so how does that increase in cash flows actually affect the value of the firm? That's what M&M Proposition 1 with corporate taxes is talking about. So this is case 2, M&M Proposition 1 with corporate taxes. So here's an example. We have an unlevered firm with EBIT of $5,000. So if we add interest, if we add leverage to the firm, we add interest. So in this case, we're assuming $500 of interest expense. That gives us taxable income, which is $4,500 versus $5,000 for the unlevered firm. Taxes at 34% is a difference of, what, $170. The net income is $3,300 versus $2,970, and the cash flow from assets is $3,300 versus $3,470. The $3,470 reflects the fact that, well, cash flow from assets is EBIT plus, just a second. Sorry, there was a telemarketing call coming through on my fax machine. So the cash flow from assets, remember from way early on in the Business 370 course, we talked about cash flow from assets, and it was essentially EBIT minus interest plus taxes. So no, that's not true. It's EBIT minus taxes, and so the cash flow from assets is EBIT minus the taxes. So EBIT is 5,000. The tax amount is 1,700 versus 1,530. So 5,000 minus 1,700 is 3,300. An all equity firm, the cash flow from assets is essentially the net income calculation because there's no interest involved. In the levered firm, we have 5,000 in EBIT minus 1,530 in taxes. So the cash flow from assets is actually 3,470. And so we have an increase of 170 due to the decrease in taxes. So 500 times 34% would be the difference of 170. So if we assume the company has $6,250 worth of 8% coupon debt and has a 34% tax rate, then the annual interest tax shield is just the tax rate times the interest payment. So that's $500 in interest expense, which is the example we've seen, and the annual tax shield is 34% of 500, so that's the 170 we saw as the difference. So the present value of that annual tax shield, if we assume it goes on forever, it's essentially perpetual. So if you never pay off the debt, you always have this interest tax deduction, and so it's basically a perpetuity. If it's properly priced at 8%, that means that the present value of the interest tax shield is actually 170 divided by the interest rate of 0.08. This is simply the perpetuity valuation formula. So it's 2,125, which actually works out if we can see the formula down here. D is the amount of the debt. The RD is the return on the debt, so 8%, the tax rate, the corporate tax rate, divided by RD. That's the discount rate to use to calculate the present value of the future tax deductions. If we see RD in the top and RD in the bottom, they cancel. So we actually end up the present value of the tax shield is the debt amount times the corporate tax rate, or 2125. So that tells us that whenever we issue more debt, the interest is adding to the value of the firm in a proportion of DTC, the amount of the debt times the corporate tax rate. So theoretically, we should add as much debt as possible, and essentially 100% debt would be the best because that maximizes the value of the interest tax shield. So that tells us about the value of the levered firm. The big finish down here, the value of the levered firm is equal to the value of the unlevered firm plus the interest tax shield. So that simply tells us that the value of the firm would go up whenever we added debt to the capital structure, in the absence of financial distress or default risk issues. So if we were to consider the impact of a change in the corporate tax rate and how that would have an impact on the corporation's desire to issue debt, if we assume the non-corporate tax environment experiences no changes in tax rates, we would expect that a higher corporate tax rate would actually increase the amount of debt in the capital structure. So there's a trade-off between the personal and corporate tax rates in the M&M propositions. So that ends up being quite a complex discussion, but the idea basically is that higher corporate taxes mean that we would see more debt in the capital structure. And essentially, higher corporate taxes mean that the firm has more incentive to shelter income from corporate taxes. All right, so case 2, proposition 1, we have an EBIT of $25 million. Tax rate is 35% this time, and our debt is $75 million with a cost of debt at 9%. The unlevered cost of capital is 12%. So the unlevered cost of capital is the cost of the demanded return on the equity investment in the firm. So unlevered cost of capital is completely associated with the equity return because it's an all-equity firm. So the value of the unlevered firm is the 25 million times 1 minus the 0.35. So that's the amount of cash flow after paying taxes. It's we're going to assume it's returned in perpetuity, and so the amount of the cash flow divided by the 0.12 discount rate is telling us that the value of the unlevered firm is $135.42 million. If we take that 135.42 and add the amount of the debt times the corporate tax rate, that tells us that the value of the levered firm is $161.67. Of course, part of that value is committed to paying the debt, so 161.67 minus 75, which is the amount of the debt. The equity owns $86.67 million. So essentially, the investment that the equity shareholders had made in the company, we're assuming that they issued debt for $75 million and used that debt to buy back the shares. So the amount of equity is just the remainder of the value of the firm. And the value of the firm turns out to be $86.67 million because we've increased the value of the firm by simply issuing debt. So this, of course, tells us that the capital structure does make a difference to the value of equity, which is kind of the opposite conclusion that we had in the previous consideration in the absence of taxes. So we can graph the effect of debt on the value of the firm, and we can see that the value of the levered firm is going up, and the maximum amount presumably would be an entirely all debt financed firm with zero or very little equity, because the line just keeps going straight up and to the right. So the value of the levered firm is always higher than the value of unlevered firm with the assumptions in M&M Proposition 1 with taxes. We can also see that the WACC, the weighted average cost of capital, decreases as the debt equity increases because the government is kicking in on the interest payments for the debt. So we know that the WACC is the equity divided by the total value of the firm, the equity weight in the capital structure times the return on equity plus the debt weight in the capital structure times the rate of return on the debt times the 1 minus the tax rate. And so the weighted average cost of capital is simply a linear transformation of those two values. And we know that the return on equity is equal to the return on the unlevered firm plus the return on the unlevered firm minus the return on the debt. So basically how much money you're making on other people's money times the debt equity ratio times 1 minus the tax rate, because the debt is taxable, tax deductible. So our example, continuing our example, 12% is the return on equity, plus we've got a 9% return on debt, so 12 minus 9% is a 3% premium. 75 is the amount of risk, or amount of debt in the capital structure. 86 is the amount of equity in the capital structure. Multiply that by the after-tax rate, and that gives us a return on equity of 13.69%, which is actually higher than our 12%. We're heavily dependent. The increase in the return on equity is heavily dependent on the fact that we're paying 9% and getting 12% on other people's money. So the weighted average cost of capital, which you can kind of see at the end here, is 86.67, the amount of equity in the capital structure over the total value of the firm, the value of the levered firm, 161.67, times 0.1369, which is the new return on the equity, plus the amount of debt in the capital structure, the debt weight in the capital structure, times 0.09 times 1 minus 0.35. So the WACC is actually 10.05%. And if we go back, so the WACC is actually still between the 9% and 12%. But we can see that the return on equity in the presence of debt is higher. So of course a higher return is consistent with a higher risk. And we do see that the presence of debt in the capital structure increases the volatility of the return on equity, and therefore it does increase the risk. So suppose the firm changes its capital structure to the point where the debt equity ratio becomes 1. What happens to the cost of equity under the new capital structure? Well, if it's 1-to-1, then the debt equity ratio is simply 1, and so we just write that into the equation. 12% return on unlevered equity plus the premium we're making on other people's money times the debt equity ratio of 1 times 1 minus the tax rate gives us a return on equity of 13.95%, which is a little bit more than we were making with the slightly less than 1 debt equity ratio here. All right, so what will happen to the weighted average cost of capital? Well, we have 1-to-1 debt ratio, so the weight in the capital structure is 0.5 each. So 0.5 times the 13.95 plus 0.5 times the 0.09 times 1 minus the tax rate gives us a weighted average cost of capital of 9.9%. So increasing the amount of debt in the capital structure moved the WACC from 10.05% up to down to 9.9%. So the increase in debt actually decreased the weighted average cost of capital. So we can put that on a graph, and this one probably looks a lot like the graphs you saw in your economics class. A couple of things happening here. We have the return on the unlevered firm debt is simply this black line. Not sure what you're seeing. I think I've set up my my video recorder so you can see a highlight with my pointer, but I'm seeing a little plus sign here, so I'm not sure what you're seeing. I see the moving picture icon. Anyway, the return on the unlevered debt is 10%, and that stays the same. The return on equity is increasing in the amount of debt, so we have an increase in the debt equity ratio along the bottom here. So the debt equity ratio, if it's 0, we're simply earning the rate of return on the unlevered firm, which is 10%. and it stays the same. So the return on the unlevered firm is 10%. The return on the equity for a levered firm, as we increase the debt-equity ratio, is essentially linear and increasing. We're assuming we have risky debt, or we have debt earning an 8% return. Our tax rate is 30%. So that gives us a measure of the return on the debt, and it also stays the same no matter what the debt-equity ratio is. So it's not impacted by the debt-equity ratio under the assumptions of M&M 1 with taxes. So what this tells us is that the return on the equity goes up with risk, with financial risk, and the return on debt does not. So overall, the weighted average cost of capital is going down, but at a decreasing rate. So the weighted average cost of capital is always going to be higher than the return on debt times 1 minus the tax rate. It's always going to be lower than the return on the unlevered firm. And so it decreases with more debt in the capital structure. So it sounds like debt is a really, really good thing and makes the firm more valuable, reduces the weighted average cost of capital, all kinds of good impacts. Well, sadly, that's not the end of the story. We can't just borrow our way to increases in value. We need to consider the fact that bankruptcy costs increase the risk. On the default side, they increase the risk for bondholders. So that means that the return that bondholders are going to demand is going to be higher when debt is increasing as a proportion of the capital structure, when the debt-equity ratio is going up as well. So if we add bankruptcy costs to the idea of the M&M propositions with taxes, the implication is that as the debt-equity ratio increases, the probability of bankruptcy increases, because essentially stock is a call option on the value of the assets of the company. So at some point, the call option is going to be out of the money, and the equity shareholders would not pay off the debt. They just let the debt holders take the assets. So if you think in terms of that characterization of common stock as being a call option on the price of the assets or the value of the assets, the exercise price for the call option is the amount of the debt. So in order to get the assets back, the firm would simply have to pay off the debt, and the assets would be all their assets. At the point where the debt is near the value of the assets, that's the point where the call option moves out of the money. So if debt is increased above the cost of the assets, or not the cost of the assets, but the value of the assets, so the amount of the debt that you'd have to pay off to get access to your assets is higher than the amount of the assets, or the amount the assets are worth, you wouldn't bother, right? It's out of the money. It's an option that's out of the money, which means that in that case, the company would simply be allowed to go bankrupt, in which case the debt holder is left with the value of the assets, and those assets may be more or less valuable than the amount of the debt. So anyway, the probability of bankruptcy increases as the proportion of debt in the capital structure increases, and it's related to the idea that common shares are a call option on the value of the assets. So that, you would think, if you were a bondholder and you thought the probability of bankruptcy was increasing, you would probably demand a higher rate of return, because that implies more risk for you. So the implication is that at some point, the additional value of the interest tax shield, which is uniformly increasing the value of the firm, would be offset by the expected bankruptcy cost, and in particular, the weighted average cost of capital would start to increase again as more debt is added. So that tells us that there's some point where there's a minimum in the weighted average cost of capital, and if that's the case, that would be the one characterization of the optimal capital structure of the firm. So bankruptcy costs. What kinds of costs are bankruptcy costs? Well, you have to pay the accountants and lawyers, so there are legal and administrative costs which you had to pay, which you would have to actually write checks for. So direct costs are things you actually have to write checks for. The bondholders would lose money, so they wouldn't presumably, or they could lose money. So the bondholders have to liquidate the assets, and liquidation values are often less than values in use, and so that liquidation value often results in additional losses. And it also provides a disincentive to debt financing. It makes debt financing more expensive as part of the direct costs of the potential for bankruptcy. Financial distress We can define the term financial distress as being significant problems in meeting debt obligations. And most firms that actually experience financial distress don't actually file for bankruptcy. There's a few ways of preventing the actual legal bankruptcy of the firm. They can reorganize. They can, in the States, they can put themselves in a Chapter 11, which gives them a little bit of time to reorganize and negotiate with their creditors. So there are a number of ways you can prevent bankruptcy and still keep the company running. But financial distress means that you're getting closer to the potential of bankruptcy. Other indirect bankruptcy costs would be, because they're not actually paid in cash, they don't affect the amount of cash that's being returned from your investment in the firm's debt. The indirect bankruptcy costs would be costs that impact the rate of return that you expect or you demand on your debt. So we're considering indirect bankruptcy costs, and of course these direct and indirect bankruptcy costs are essentially costs to the shareholders. So we're concerned about costs to the shareholders. So indirect bankruptcy costs are all kinds of financial distress costs other than the actual checks you have to write. And so they would include things like the reputation of management and the likelihood of being able to get another job if this one goes away, those sorts of things. So in general, they're thought to be larger than the direct costs, but they're very hard to actually determine what they would be. So stockholders wish to avoid formal bankruptcy filing because it's very expensive both in indirect costs and direct costs. So bondholders want to be able to make sure that the value of their assets, the ones that are dedicated to paying their bond out, that they're at least as valuable as the amount of the debt, so that when all the bankruptcy costs are paid, they still can get their money out of it. And the indirect bankruptcy costs would include the idea that if management is wasting all of their time trying to prevent bankruptcy rather than running the firm profitably, that reduces the value of the assets because they're not being as productive as they could be. And bankruptcy costs, if the public is aware of bankruptcy costs, they may stop buying things from the firm. So if you think sort of research in motion and the BlackBerry phone, it used to be that a lot of people, even the Hollywood set, had BlackBerries in their pockets. But then research in motion wasn't keeping up with the technology, and as a result ended up in financial distress. And so a lot of people decided not to buy BlackBerries based on the fact that they weren't sure they would get support from the company. So that would result in lost sales. There's a number of different costs that would be associated with firms that are not financially stable. So that being said, if we look at the static theory of capital structure, the idea of the optimal capital structure, it's somewhere in the middle. Now remember the previous graph we saw, which is back up here. We can see that the weighted average cost of capital is uniformly decreasing, approaching the after-tax cost of debt with no resulting increase. So the minimum weighted average cost of capital is something with the maximum amount of debt equity. So if we had an entirely debt-financed firm, the weighted average cost of capital would be the cost of the debt times 1 minus the tax rate, the after-tax cost of debt. Well, what this is saying, if we add bankruptcy costs to the mix, the optimal capital structure is actually determined at something less than an entirely debt-financed business. So we essentially have the optimal amount of debt would be less than 100% because of the potential financial distress cost. So if we're graphing the value of the levered firm, we said that previously with the assumption of no financial distress costs, that is just increasing and right, sort of linear, increasing by the amount of the debt times the corporate tax rate. Well, we see if we add financial distress costs, at some point, the present value of the future cash flows available to debt are going to be going down, so they're going to demand a higher return, and as a result, the value of the firm is not going to uniformly be equal to the unlevered firm plus the the corporate tax rate times the amount of the debt, because the required return on the debt would actually go up. So the present value of the tax shield on debt would actually be diminished by the fact that there are financial distress costs in addition to the cost of debt. And those financial distress costs are not tax deductible explicitly. So the actual firm value at some point would start to decrease back to the value of the unlevered firm. And so at some point you would expect there would be a maximum to this little pink curve here. And that maximum would be theoretically the optimal value of the debt, or the optimal amount of the debt. So the gain from the tax shield on debt would be offset by financial distress costs, as it says down here. So firms borrow because tax shields are valuable, but borrowing is constrained by the costs of the financial distress. Now, if we put it back into the form of the graph that we saw before, this is the old graph. The weighted average cost of capital is asymptotically getting closer to the after-tax cost of debt, and the more debt, the better. Now we transform that to the graph with a consideration of financial distress costs, and we see a couple of things that are new. One is that the return on debt at some point is actually going to be increasing because of the financial distress costs. We're going to have to pay them more because they're taking more risk. And so the debt, the return on debt, is no longer just a line all the way across. It actually increases in higher debt equity ratio levels because of the extra riskiness. And as a result, the weighted average cost of capital, instead of uniformly going down, is now starting to curve back up again because debt is becoming more expensive. We can see that return on equity is still more expensive, so the financial risk costs increase the demanded rate of return on equity. But now we see that the financial distress costs also have an impact on the debt side, and so both of the returns in weighted average cost of capital are both going up. The weighted average cost of capital goes up again. And so we see that right at the bottom of the trough here, not sure if that's exactly accurately graphed, but that the bottom, the minimum of this curve, would represent the minimum cost of weighted average cost of capital. So that maximizes the value of the firm because all the cash flows of the firm are divided by the cost of capital. So that maximizes the value of the firm, as we saw in the previous graph. The debt equity ratio, which is optimal, is determined by the trough at the bottom of this curve. So, quick recap of the ideas behind the optimal capital structure and the M&M propositions. Case 1, if we have no taxes and no bankruptcy costs, then firm value is unaffected by capital structure because there's no tax shield. On the other hand, if there are corporate taxes but no bankruptcy costs, then we should have as much debt as possible in the capital structure. So the optimal capital structure is 100% debt, because that minimizes the weighted average cost of capital and maximizes the value of the firm. So each increase in debt increases the value of the firm. In case 3, corporate taxes and bankruptcy costs, there is an optimal capital structure, which is something less than 100%, and it's determined by the presence of bankruptcy costs. So that is the summary of the M&M propositions. And the case which is closest to the reality, of course, is case 3. So essentially we're relaxing the assumptions, the very rigorous assumptions of case 1 and 2, and we see that the optimal capital structure is partly debt and partly equity. Now, a lot of Christian managers of firms take the position that they want no debt whatsoever, and so there are a few references in Scripture to the dangers of having debt. Solomon talks a lot about the dangers of debt in his Proverbs, and refers to things like the borrower is servant to the lender and those sorts of things. Paul tells us that we should owe no man anything but to love one another. So there are certainly some good biblical reasons to avoid debt. This whole discussion says that as long as debt is less risky than equity, and as long as the assets of the firm are worth more than the amount of debt, we're not actually taking a net debt position, and so the optimal capital structure in terms of the value of the firm is somewhere between 0 debt and 100% debt. And so a strategic choice of optimal capital structure would actually increase the value of the firm for the owners of the firm. Okay, so the summary of the three cases can be seen in the slide here. We can see that there's an optimal value of the firm. In the case of bankruptcy costs and taxes, the value of the tax shield goes up to some point where it's actually offset by the present value of the bankruptcy costs in the future. That's corresponding with the optimal debt equity ratio, which is the minimum amount of the weighted average cost of capital. So case one says that if there are no taxes and no bankruptcy costs, then capital structure doesn't matter at all. In case two, the amount of debt in the capital structure is uniformly good. The more debt, the more value, so you should keep adding debt until you can't add any more. And then in case three, the static theory of including the bankruptcy costs, including the financial distress costs, says that there's a maximum value of the firm and a minimum weighted average cost of capital. And that's the target that you should aim for in choosing your capital structure. All right, then. We can talk about some managerial recommendations as a result of what we've learned through discussion of the M&M propositions. The first thing is that the higher the firm's tax rate, the more important the tax shields are. So a higher tax rate means that tax shields of interest and depreciation and all the other tax shields become more valuable because the amount that the government is kicking in for deductions is higher. It also implies that financial distress implies that a low risk of distress implies higher borrowing ability. So if you have a firm which is generating lots of cash flows and has lots of assets to use as security, then that implies that you can borrow more because it's less likely that the firm will be put into bankruptcy. And even if it is put into bankruptcy, it's more likely that the cash flows owed to the debt holders would still be paid. So in theory, the static model of capital structure that we described in this section applies to both multinational firms and domestic firms. And so the multinational firm should seek to minimize its global cost of capital by balancing the debt-related tax shields across all of the countries in which the firm does business against their global agency and bankruptcy costs. So among other things, however, this assumes that worldwide capital markets are well integrated and that foreign exchange markets are highly efficient because there's an interactive effect between the foreign exchange and the cost of capital in different settings. And so in such an environment, financial managers would seek to optimize the global capital structure as opposed to just the domestic capital structure for a domestic firm. And in practice, the existence of capital markets which are not completely integrated across different portions of the world, differential tax rates, differential regulatory contexts, it make it really difficult to determine the global optimal capital structure. So the theory says we should optimize across all of our global operations, but it's really difficult to actually determine what that optimum would be. So it's more likely that we would determine the optimal capital structure in each country individually. So the tax benefit is essentially only important if the firm has a large tax liability. So if you've got a large a high tax rate, a high corporate tax rate, then the tax benefit becomes more important. And if there's more financial distress, that means that the cost of bankruptcy has a larger effect on the weighted average cost of capital and the optimal value of the firm. And so more financial distress means less debt. And that seems fairly obvious and fairly reasonable. The cost of financial distress would actually vary across different firms and different industries. So you would have to determine that cost for your own industry. And that would help you to make good decisions as to optimal capital structure. Now, moving on to, we talked earlier in the text about the pie. Essentially, the value of the asset, the cash flow from the assets is, we discussed that in Business 370 way back early in, I think it was like chapter 3 of the textbook. And so we essentially said that the cash flow from the assets represents a pie which can be segregated however you like between creditors and stockholders. And it doesn't really matter which of those you are. You may have different contracts and different expectations about future participation in future cash flows and those sorts of things, but the amount of the future cash flows is just divided between the stakeholders. And so if we take that idea that all we're doing is dividing the value of the firm among the interested investing parties, we can extend that with regard to the M&M propositions, and we can see that once again the value of the firm is essentially just a pie that we cut into pieces to determine who owns what, and we can change the amount of debt in the capital structure. And so to the left we have low financial leverage, so the stockholder claim is much bigger than the bondholder claim. The ratio between those two would essentially be the debt equity ratio. So higher financial leverage means that there's a higher bondholder claim relative to the stockholder claim, so higher debt equity ratio. Presumably higher financial leverage means that we reduce the tax claim because the interest is going to be higher because we're have a higher amount of debt in the capital structure. But it also means that the bankruptcy claim, the riskiness of the bankruptcy, the financial distress costs increases the potential benefit there. So the bankruptcy claim essentially makes the cost of the bondholder's claim higher and reduces the tax claim. And at some point, you're going to balance these two out so that everybody's relatively happy. So the M&M propositions basically say that the company's business is what creates value, and so that value is just distributed between the stockholders and the bondholders, and the degree of debt in the capital structure determines what the optimal relationship is between those two. Now you're probably thinking about how the bankruptcy costs and tax claims actually enter into the value of the firm, and so we're talking about that here. The value of the firm is essentially all the marketed claims plus all the non-marketed claims on the value of the firm. So the pie is basically made up of 4 quadrants. 2 of them are marketed claims, the claims of the stockholders and bondholders, and the non-marketed claims are the claims of the government for taxes and other potential stakeholders. So presumably the accountants and lawyers in the bankruptcy case might fit into that category. But the overall value of the firm is unaffected by the changes in capital structure because the amount of cash flows that they can actually generate overall is determined by the business that they're in. So the division of the value between the pieces of the pie might actually be impacted by the capital structures, but by your capital structure decisions. So clearly there's a difference between high leverage and low leverage claims for the bondholders and stockholders. The division of the pie matters. Capital structure matters for the division of the pie, but not for the size of the pie. Now there are some shortcomings of the static theory, and we can see that many large profitable firms and a lot of firms managed by Christian managers use very little debt, and we might ask the question, why is that? Well, it could be because the fact that selling additional securities is expensive and takes your mind away from the management of the firm and really doesn't provide any extra value. So if the firm is already profitable, you may never actually need to get external financing. So if all you're doing is creating value for your firm, for your customers and for your shareholders, then you might not actually need to borrow any money, in which case you wouldn't have a lot of debt in the capital structure. Which brings us to the pecking order theory. The pecking order theory says that To the extent that internal financing is available, firms will use that first. Because it's relatively inexpensive, already under the control, doesn't require the issuing of any new securities or any new contracts, doesn't impinge on their ability to manage the firm. Lots of reasons to use internal financing first. And then they would issue debt as the next choice because the debt is a relatively low cost of capital. Comes with some additional constraints on management, so there's some indirect costs as well as direct costs, but in general, it's less expensive than issuing new equity. The equity would be sold as the last resort because it's very expensive, as we talked about in last chapter, chapter 15. The cost of you issuing new capital is fairly significant, getting all of the investors, the investment brokers involved, and the accountants and lawyers and IPOs and prospectus documents, all those sorts of things are very expensive to do. So in addition to that, issuing more debt means that you can recover it, right? So issuing more debt is generally seen as a signal. And so when managers issue more debt or even sell more equity shares or buy back shares, there are implications for the market. So the market views some of these things as signals. We talked a little bit about the repurchasing of shares on the market being a very strong positive signal because it tells the market that managers are pretty sure that the equity is overpriced in the market, and so they're taking cash out of the firm and making it more difficult to manage the firm as a result, because they already have that cash in the firm. They wouldn't need to raise extra financing, but making the choice to buy back shares is a very strong signal that they think the prices are overpriced and that they can still manage the firm profitably even after expending cash to buy back those shares. So there's definitely a strong signal and component to transactions with the capital markets, and as a result, managers tend to like to leave that alone. Many firms don't actually have a target capital structure in mind. That's one of the implications of the pecking order theory. The profitable firms would use less debt because they have greater internal sources of financing, so they don't actually need to go to the external sources to get their financing. And companies want to have financial slack, and so they want to have the ability to operate without constraint, and so debt comes with constraints. And so one of the reasons you see very little debt is because it increases the amount of say that other people have in the operations of the firm. A couple of statistics. On average, U.S. non-financial companies borrow about $1 for every $3 of equity, so that implies about a 1 to 3 debt-equity ratio. Different industries typically have different debt-equity ratios, and that would depend on things like income and cash flow variability, the nature of their assets, whether they can be used as collateral. So firms, very large utility firms, tend to have a lot of debt in their capital structure because they can afford it. They have replicable cash flows because they've got kind of a captive audience, and so they can sell their services to make a predicted amount of profit. There's a lot of industries, or utility industries, that are actually government regulated in terms of their profitability, and basically they make money by adding to their assets because they're guaranteed a certain rate of return on those assets by the government, allowing them to have an oligopoly or monopoly position, and as a result, they're constrained in the kinds of excess returns they can have, but they're guaranteed a certain minimum return. But also cash flows. So utilities, in Edmonton, you wouldn't forego buying natural gas because it's too expensive. You're going to pay your gas bill because otherwise you'll be freezing in the dark, as a certain premier once said. Now, the nature of the assets, the fact that pipelines and large utilities and all of these big, what's the word I'm looking for? Equipment, capital-intensive industries. Capital-intensive industries have lots of stuff that they can use as collateral, and so banks tend to like that sort of thing, and so they're quite willing to lend on the basis of physical capital. Human capital may be a different thing. It's really hard for you to convince banks that your human capital is something that they should lend against because it's really hard to value. So capital structure does actually differ by industry. There's definitely a connection between different industries' operating characteristics and their capital structure. And firms and lenders will look at the industry's debt-equity ratio overall as a guide to what would be optimal for your particular firm. So the implications of the pecking order: firms usually don't have a target capital structure. Profitable firms would use less debt because they have more internal sources of financing, and companies don't want to be constrained by the limits placed on them through the issuance of more debt. All right, so capital structure is different in different industries. So service-oriented, accountants and lawyers don't tend to have a lot of debt in their capital structure. Insurance companies don't have, well, maybe that's a bad example because they're insurance companies and it's a financial firm. But non-financial firms that are essentially service firms tend to not have a lot of debt in their capital structure because they don't have collateral assets and they don't have replicable cash flows. So if you're talking about your big phone companies, cell phone companies, they tend to get paid every month because people need their services, and even in months where you aren't making a lot of money, you're still going to pay your phone bill. So definitely some differences. Capital-intensive industries tend to be heavily debt-laden because the cost is relatively low, because they've got replicable cash flows and secure assets that they can use as collateral for borrowing. Now a little bit more about the bankruptcy process to fill us in on exactly what the financial distress costs are. Essentially, bankruptcy happens because of business failure, which is a situation where a business has terminated operations because of the loss to its creditors. A legal bankruptcy is brought about by the creditors bringing petitions to the court and petitioning them into bankruptcy. And so bankruptcy is actually a legal proceeding, and the idea is that they liquidate or reorganize a business to satisfy the claims as much as possible, satisfy the claims of the creditors. Now, technical insolvency means that they can't pay their bills as they become due. So it occurs when a firm defaults on a legal obligation. For example, it doesn't pay a particular bill, then the creditor has the right to proceed to bankruptcy if they never get paid. Accounting insolvency basically means that the book value of the equity is negative, which means that the debt is higher than the value of the assets. So you end up with a deficit position. In that case, it's not the same as legal insolvency, but it's an indicator that the firm is basically in financial distress. So that's one of the measures of insolvency. So continuing in our more detailed discussion then, liquidation is when you've terminated the business and you're selling all of the assets. The liquidation is basically where the firm is placed into bankruptcy or under receivership, and there's someone, a trustee in bankruptcy, who takes over the firm and determines how to sell the assets, presumably getting their maximum value. The creditors, often banks, hire lawyers and accountants to act as trustees and to kind of manage the process. And so essentially the firm ceases to exist after liquidation because all of the assets have been sold off. Now, it can be the case that you can reorganize the firm and keep it going by reducing the old claims and replacing them with new claims of new securities. So the new securities take place of the old securities. In liquidation, there are lots of expenses associated with the bankruptcy. You have to pay the trustees and the lawyers, and so there are a number of costs. You have to pay. I actually worked for Coopers & Lybrand Limited for about 8 months in their bankruptcy department, and so one of the things that I did was I went out and I counted inventory, and I structured inventory for sale. So I looked through accounting records to determine what the cost of the assets were, if I could determine that, and so that has implications for the value that somebody might pay for them. We had a number of of clients where we just sold all the assets to an auction company, and the auction company gave us a bid as to what they would pay for them, and so we just basically walked away from it. They were allowed to use Coopers & Lybrand Limited, our trademark name, as part of the auction procedure. So they've got the value of Coopers & Lybrand's a relatively famous name to help them in the auction proceeds. There were a couple of different auction companies that we commonly used for the auction processes. There was one relatively new one, and the relatively new one would take the information about the cost of the assets, and they would actually give us a cash bid for the assets, or they would just do a regular bankruptcy auction and give us a percentage of the proceeds. The other competing firm, which is still around, Missioner Auction, you can see Missioner still has auctions of well, they have regular automobile auctions, but they're still around. They would basically, rather than doing a cash claim, they would just bid on the cost of their services as a percentage of the proceeds. And banks tended to take the cash claim for whatever reason. Obviously, there's less uncertainty involved. So anyway, reorganization would be a case where you didn't liquidate the assets, and in liquidation, all of the assets are sold. The ones that have security are used to pay those secured claims first. If there are any leftover secured claims which aren't paid by the proceeds from the assets, then they just become unsecured creditors, and they fall into the hierarchy. So the liquidation under the Bankruptcy Act has a particular priority. So the first thing that gets paid is all of the expenses associated with the bankruptcy. So the trustee wouldn't do their work unless they were going to get paid. So the first thing that gets paid out of the liquidation proceeds is all of the costs of the bankruptcy. If there are any other expenses arising after filing, but before the appointment of a trustee, those would need to be paid next. Wages, salaries, and commissions, so the ones owed to the employees, would be paid next. Then contributions to employee benefit plans, so their pension plans, would be covered. And then if there are any consumer claims against them, so claims for shoddy workmanship or damage caused by their product, that would be paid next. A fairly unusual situation. And then the government gets paid next, because the government is the government and they wrote the law, so they get paid next. And then the unsecured creditors get paid. The secured creditors actually have the claim on the assets prior to all of them, so they're kind of removed from the situation. Secured creditors get the proceeds from particular assets, and so they get the first claim on that. So they don't actually fall in this list because they, to the extent that they are secured creditors, have claims on particular assets. Then the unsecured creditors are paid, and that may include some secured creditors who haven't been completely paid out as a result of their claim on particular assets. Then next, preferred shareholders, and whatever is left over goes to the common shareholders as the residual interest in the firm. Now, bankruptcy or reorganization also has a sort of sequence of events rather than an order of distribution of the proceeds, but the firm continues to go. So the first step is they have a voluntary or involuntary petition, so it's either brought by the creditors or brought by the creditors in conjunction with the management of the firm and their shareholders. So voluntary means that the management and shareholders are on side. The involuntary petition is one that's brought by creditors in conflict with the managers and shareholders. Then they bring it before the judge in court. The judge approves or disapproves the petition and sets a date for filing all of the claims, so that you know who is owed what by the business. The firm continues to run the business, or it actually may be run by a receiver appointed by the court. The firm would submit a reorganization plan to the court, and the creditors and shareholders would have claims to comment in the court proceedings as well. The creditors and shareholders would get divided into their appropriate classes, and if the creditors accepted the reorganization plan, the plan would be confirmed by the court, and then any payments in cash, property, and securities would be paid out as instructed by the court. There may be new securities issued to finance the new reorganized business. And so the liquidation, the company is dead. the reorganization of the company stays alive. So a couple of things to think about. First of all, the right to go bankrupt is valuable because it stops creditors from demanding claims and from sending final notices and all those sorts of things, and gives you a pause so you can think about how you can reorganize the business to keep it going if possible. Chapter 11 serves that function in the States, so you might have heard Chapter 11 referred to in that context. And excuse me, the right to go bankrupt actually may be used to improve the firm's strategic position because it allows them some time to avoid thinking about the creditors and figure out ways to make the value of the firm increase again. You can actually make voluntary agreements with your creditors ahead of time to avoid bankruptcy at all. So voluntary arrangements to restructure debt are often made. An extension postpones the date of payment, so that means that we're going to pay you, but it's going to take us a little longer. Composition of a firm that refers to the willingness of creditors to accept a reduced payment. And both of those are possible because the costs of actually going through bankruptcy and waiting for the whole process to be finished can be fairly expensive and fairly time-consuming for the creditors. So think about these questions as the quick quiz. What's the effective leverage on earnings per share and ROE? Those were the examples at the beginning where we talked about the current versus proposed situations and determined that leverage increases the variability of EPS and ROE. The break-even EBIT is the one where we determined that the earnings per share was the same in both cases. And the optimal capital structure, the whole M&M discussion, revolved around optimal capital structure. There were three cases, one where there were no taxes and no bankruptcy costs, in which case the optimal capital structure was not applicable because there was no capital structure. Capital structure doesn't matter. In the case of corporate taxes that apply to interest but not to dividend payments, the amount of debt in the capital structure, more is better. And then when we added the idea of bankruptcy or financial distress costs, that implied there was an optimal point for the valuation of the firm and for the weighted average cost of capital. Difference between liquidation and reorganization. Liquidation, the firm is gone. Reorganization, the firm stays in existence in perhaps a modified form. So these are all the things we talked about. These are some important formulas you might want to put into your arsenal for the resource sheet. Yeah, we didn't actually talk about the relationship between corporate and personal taxes. So interesting idea. So you can take a look at that. Essentially, the implication is that when 1 minus the tax rate on corporate tax and the tax rate on shares, so capital gains plus dividend, is equal to 1 minus the tax rate on interest from debt, then essentially this goes away and the value of the levered firm is exactly equal to the value of the unlevered firm. So if this is equal to 1, there's no value to additional debt in the presence of corporate and personal taxes. Not sure I want to say a lot more about that. You can work through these examples if you like. That's probably enough for us. So that's it for Chapter 16. Hopefully I'll be back on Monday and we can work through some interesting in-class problems. That's it. Thanks. Bye.